The headlines on Friday were gloomy. India's private sector growth, they said, just slumped to a 3-year low. The number behind it was a PMI reading of 54.3, down from 57.1 the month before. And yet, here is the strange part. That very same number, 54.3, also means the economy is still growing. Both things are true at once. Slowest in 3 years and still expanding. That is not a contradiction, and it is not spin. It is simply how this particular kind of number is built. The PMI is one of the most watched and most misread indicators in the world. So today, let us open it up and see exactly what a reading of 54 is really telling you, and what it is not. Here is the idea that unlocks everything. A PMI is not like GDP. GDP measures magnitude, how much bigger the economy got. A PMI is a diffusion index, and a diffusion index measures breadth and direction. How many businesses are doing better versus worse? Every month, purchasing managers at hundreds of companies are asked a simple question about activity, new orders, output, employment. Is it higher, the same, or lower than last month? Their answers get boiled down to a single number on a scale from 0 to 100, and the whole scale pivots on 1 point, 50. Above 50 means more firms reported improvement than deterioration, so activity is expanding. Below 50 means more reported deterioration, so activity is shrinking. Exactly 50 means no change. That is the first thing to burn into memory. The 50 line tells you the direction. So 54.3 is comfortably above 50, which means the majority of Indian firms were still growing in July. The economy did not contract. It kept expanding. So how does that single number actually get made? Walk the steps. First, a survey firm polls purchasing managers across manufacturing and services. Second, for each question, it counts the share saying better, the share saying same, and the share saying worse. Third, it runs a simple formula. The percentage reporting better plus half the percentage reporting no change. That is the diffusion calculation, and it lands you between 0 and 100, pinned at 50 when improvers and decliners exactly balance. Now one more distinction you must know. The number released on Friday was a flash reading. Flash means it is an early estimate based on the first big batch of survey responses, usually around 85 to 90%, released before the month even ends. The final reading comes a week or so later once the rest are in, and it can be revised up or down a touch. So flash is fast but provisional. Final is complete but late. Markets react to the flash precisely because it is the earliest read on the month. Now apply this to Friday's actual numbers and the so-called contradiction dissolves. In June, the composite reading was 57.1. In July, the flash came in at 54.3. Two facts follow, and you must hold them separately. Fact 1, the level, 54.3 is still well above 50, so a majority of firms were still expanding. India's private sector grew in July. Fact 2, the momentum. The reading fell by nearly 3 points from June, and that drop is what makes it the weakest since March 2022. So growth continued, but it became less broad-based. Fewer firms were improving than the month before. Here is the trap that catches almost everyone. A falling PMI that is still above 50 does not mean the economy is shrinking. It means the economy is growing more slowly or less widely. The direction is still positive. The pace eased. Think of a car. The speedometer reading dropping from 57 to 54 does not mean the car reversed. It means it is still moving forward, just a little slower. Confuse the change in the number with the level of the number, and you will read a slowdown as a recession. They are not the same thing. The single composite number also hides something important, and this is where a careful reader goes next. Which engine actually slowed? A composite PMI is a blend of two separate surveys, manufacturing and services. Split them apart and the July story sharpens. The services business activity index dropped to 53.1, its weakest in 53 months. More than 4 years. That was the main drag pulling the composite down. Manufacturing, meanwhile, eased more gently, its flash reading around 53.9. Both are still above 50, so both are still expanding. But the deceleration was concentrated in services, not factories. This matters because services are the larger part of India's economy, so a slowdown there carries more weight, and it is a reminder never to stop at the headline composite. The blended number can look like a broad slowdown when really one component is doing most of the moving. Always ask which side, manufacturing or services, and which subindex, output, orders, or employment, is driving the change. So here is the lens to carry into every PMI release. 3 questions in order. First, which side of 50? That tells you the direction, expanding or contracting. 54.3, expanding. Second, which way did it move and by how much? That tells you the momentum, accelerating or slowing. This month, slowing to a 3-year low. Third, what is underneath? Manufacturing or services, and which subindex? That tells you where the change came from. This month, mostly services. Get those 3, and you can read a diffusion index better than most of the people quoting it. Notice what a PMI does not do. It does not measure how much the economy grew, and it does not predict what comes next. It is a fast, raw temperature check on business conditions, published before the hard data, which is exactly why markets watch the flash so closely. So the next time a headline says growth hit a multi-year low while the number sits comfortably above 50, you will know both statements are true. And you will know precisely why. For more on how the numbers behind the markets are actually built, subscribe. This is educational, not financial advice.